next class, but you've had the ability to get an actual copy of Active Retirement Investing class workbook. It's 275 pages, so there's a lot of content in there. We're going to start today on page 104, but I want to remind you, in the book, make sure that you take a look at the back part. There's not only a little 25 question test, which is kind of fun at the end of this course, and you've read the book, see if you can pass it just for fun. But there's a 3-page readiness list that has everything that includes the financial and estate planning, boring stuff that we're not going to talk about, but you need to check off each one, or if you don't need items, you declare that. But you go through those 3 pages and get yourself ready to have everything done and in place, or you're working on it already. And then there's an outline of what you should be doing on the investment and financial planning process, or if you have a family member or a professional do it for you, what he or she should be doing. And there are specific points on there that if you hire an advisor, what he or she should be doing and what they should not be doing. And then more importantly, if you work with somebody, make sure that you go to the government website and check their background. Now, for those of you doing your own investing and planning, that's what the checklists are for. We're here to help you do all this totally by yourself or with a partner or a family member. But we want to make sure that you check off the boxes based on what I believe someone should do. This is educational only, so obviously you're not going to go out and react immediately. And we're more of an engineering process for your investments in your portfolio, taking into consideration the financial planning and the estate planning part, but we're not going to cover those in great detail. They're covered in the book. We have diagnosis, or diagnostics as we call them, for cash flow, insurance, taxes, legal, and in individual investments and portfolios. So you'll learn how to look at all that stuff if you want to take it on yourself. By all means, be empowered to do the financial planning, the investing, and the estate planning process by yourself. However, it's a lot of information, and if we're retired, you may not want to do that. So I want you to look over the shoulder of your family member or a professional that's helping you and have some awareness of what they should be doing for you. So you'll have some concept of what's out there. 20, 30 years ago, you had commission-based products and insurance products and things like that that are no longer, in my opinion, relevant for the current investment portfolio. So we need to be very careful that whoever's investing your money, and if they're doing good intentions, but they're not really well educated themselves, make sure they take a look at the workbook and follow through what we're talking about. I'll go to the first slide in a moment, but as we get into this class, today's class is talking about the portfolio, right? But we talked a little bit before about what fills the portfolio. Some of you have individual stocks and bonds, great. Some of you have real estate investments outside of this, great. But for the individual, a diversified portfolio with several different investment company investments, the Schwabs, the Fidelity, the Vanguard, the iShares, and so on, we want to diversify a portfolio among several different issuing companies so we don't have all our eggs in one basket. And then we'll look at a portfolio with several different funds in it that are made up of exchange-traded mutual funds. They have the benefit of the diversification of mutual funds, but being exchange-traded mutual funds, they have the benefit of trading like a stock. Now, there's techniques and things to consider in there, and I want you to be very careful that you don't get in trouble. So take this as educational, but you'll need to learn a little bit more how to buy things throughout the day if you choose to do a portfolio like this. So let me go to the share button here, and if I don't get too glaring here with the glasses, we should be taking a look at a slide here that tells you about the next Friday forum. Hopefully I got the date right, the 25th of February. And it's landmark battles for fair housing. So that might be very interesting. Take a look at that real quick. That's what's coming up this Friday. And a couple more seconds, and then I'll go to our slides. Okay, today we're talking about portfolios. Now remember, in my opinion, the best portfolio is one that's held in a brokerage account at a major large company, a Charles Schwab, a Fidelity, a Vanguard has a brokerage account that you can utilize, the Robinhood and so on. They all have their little quirks that are better than others. And in that portfolio, you can buy a mutual fund, as we learned last week, from Vanguard or somebody else, but you'll have to buy it, put in the order today, and it'll get bought at the close of business tonight. Now, that's not a big deal. A lot of people make a big thing out of that. No, you got to buy it right in the moment. Well, the market can go haywire during the day. So if you're a passive investor, buying a fund at the end of the day is not a big deal. And if you go to cash out at the end of the day, not a big deal. But we would like to utilize the exchange traded funds and buy them carefully anytime during the day. I'm told the first hour of trading and the last hour of trading historically have been the most volatile, so maybe stay away from that. But if we live on the West Coast, we're already 3 hours behind. So if we utilize exchange traded mutual funds in our brokerage account, you can transfer old managed mutual funds from a mutual fund company to that brokerage account usually. And we're not going to go into great detail. It's covered in the book, but the old managed mutual funds have very high management expenses. The new exchange traded funds let you break down what that fund is. Is it a total market index fund that does nothing but place the stocks in there that the index requires? That should have a super low management expense because they're not managing anything. They're just putting in inventory. And then every, I think, quarter or so on, they'll check the index publisher and see, do they need to rebalance this if things change? But generally an index fund is a one and done. You buy and hold, and they shouldn't be a very high expense ratio. 0.02 to 0.808 is a possibility. But then there's also some exchange traded index funds that might rebalance more often based on the market, not the size of the company in the index. So that gives you some leeway. The exchange traded funds can also have passively managed. We'll reallocate, and if this changes, we'll do this or that. So very minor little changes. Their expense ratio, I'm guessing, might be 0.15 to 0.35, and it lets you pack in a different recipe of positions than just an index. Today, we're seeing that. The S&P 500 or the total market index is down over 9% year to date, yet one of these specialty index funds that said, we're going to do the S&P, but equally weight all the stocks. Apple will have the same weighting as some little small company and spread them out equally across the board. Well, that wouldn't have made you as much money in the last 10 years because Apple and all the tech stocks that take up the index made you more money. But in the last month, we're loving these total allocated funds that don't have all our eggs in tech because tech's down a lot. So in the exchange traded mutual funds, you can do all the index funds that you want. You can do specialty indexes like small cap versus large cap and so on, utility index, but you can also do passively managed or allocated. And you can also do exchange traded mutual funds that are actively managed, that buy and sell and do everything the old mutual funds did. Be careful, though, to watch out for the expense ratio. Just because it's an exchange traded fund doesn't mean it's super cheap. So look at the bottom line. We talked about that before, and you'll see areas in the book that'll teach you where to look at the expense ratio of a fund. And also remember, just because a fund has a low cost to manage or put it together, an index fund, doesn't mean you will do better in tough times. Right now, the low cost S&P 500 index fund that costs 0.015 or 0.02, it's down 9.5%. It's not the fund company's fault. It's just that index. Whereas had you done other types of indexes or allocations, who knows how you might be? You might be down half as much. That depends on the beta and the risk. There's no predicting the future. Absolutely. So let's take a look at some of the areas that these exchange traded mutual funds look to buy stocks and hold, whether it's an index fund or a specialized one. These are all the sectors that are available in the US and international and global. US, we know what that is. International, usually Europe and global takes into account a lot of the Asian countries and things like that. Well, we all know utilities. You can find a utilities index fund that does nothing but utilities. You can find agriculture, or I'll go to some of these other consumers or consumer staples, communication, the technology and communications. There are exchange traded mutual funds out there that buy nothing but real estate investment trusts. I would recommend, if you're going to go into that area heavily, go by way of an exchange traded mutual fund, not one of these steak dinners. I would avoid those completely because they're not liquid and there's a lot of costs built into them. And that very eager broker is going to make a lot of money if you buy that non-liquid partnership or real estate investment trust that's not publicly traded. That's my opinion only. Read the paperwork. But you can buy them in an exchange traded fund. That's the cool thing, is that if you do that, you can get in at 9 o'clock in the morning and get out by a certain time of the day. I don't encourage people to do that, but I'm just saying it's very liquid. You can get in and out most of the time if it's a highly traded, exchange traded mutual fund. Currency funds out there, energy, we see energy is up a lot. March of 2020, energy futures were at a negative value and cost of energy was way down because obviously we didn't think anybody would go out of their house and do anything or drive. Well, since then, as things have picked up and people are moving around and the economy is expanding a little bit to catch up, energy is up an extremely high level. And those people that have energy funds have made a substantial amount of gain. The question is, when should they get out? We don't know. Natural resources and metals, that would be timber and various other metals, health, biotech, financials. Financials back in March of 2020 were down significantly more than everybody else because people thought the banks and the insurance companies would slow down. But after they recovered, they're up significantly, and they tend to benefit when interest rates are on the rise because then that increases the yield on the loans and the savings that they can earn off of their shareholders and their savers. Technology, obviously, long-term has done fabulous, but now we're in a bit of a divot, and I don't know if that's short-term or long-term. But a lot of the big technology companies are going to be, in my opinion, looked at more like a utility company at some point. So they're good investments. They make good money, so there's nothing wrong with that. New small technology funds, that's where you'll have more upside and more downside. Defensive funds, some that will put 80% in the S&P 500, and that other 20%, they'll try to do certain types of derivatives and options to save you on the downside. But in this last month, I haven't seen them do such a great job, and cyclical. So these are just some of the sectors and the mixes of areas that you could go to one of them and double down, wouldn't recommend it, or you could diversify them all in a broad market fund, and that would be great. And if they're equally weighted, they're not down as much as the S&P 500 because they're not all one technology. They're not all technology. They're not all one sector. So if you're defensive, you want to be more diversified. But if you're going more for growth, then you have to pick one of these sectors that you think might go somewhere. And there's a little over 100 million traders out there globally. And how on earth do we know how they're going to react tomorrow? So if you're looking at good value long-term, then plan that out. And as we've talked about, look at short-term, intermediate, long-term positions in your portfolio. Short-term might be treasury funds that are very short-term, exchange-traded treasury mutual fund. You're not there to make any money. You're just there for protection, that you have the government backing. And as soon as the market crashes, you have that money to move back into the market, for example, or if you have another need for cash. The intermediate term funds in the portfolio would be those that can take a little bruising, will be invested in short-term corporate bonds, maybe short-term corporate bonds and low volatile corporate stocks. There are funds out there that are low vol ETFs. Low volatility corporate stocks. Well, what's low volatility? Is it a brand that says, wow, you invest with us and you won't have any volatility like a lot of these insurance companies say? No, these are stocks that have a history of less volatility, but it doesn't mean they won't drop significantly. They actually dropped more than the overall market March of 2020 because they were old, staunchy stocks with big dividends. And when we thought that they wouldn't be paying dividends in the future, they crashed. Now they rebounced fairly quickly, and they've been very good for people who bought them at a low point. But there's no free lunch out there. If it says we're low vol or low volatility, why is that? And in this case, it's usually stocks that have already peaked and are over the hill. Now they've stabilized, fine. They're giving us really big dividends. We like that. The old blue chip concept, but it doesn't guarantee you anything. Fund broad market parameters. The interesting thing is, if you look at the broad market, we're going to be positively correlated to the broad market. So if you get a broad market index fund that buys a little bit of everything, and the broad market goes up or down, your fund tends to follow that, especially if it's a very low cost index fund. But some people want to have, instead of all my money be positively correlated, so if the S&P goes up 10, I make 10. If it goes down 20, I lose 20. Some people say, no, 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 I'm retired, close to retirement. That's too much volatility. So maybe along with an S&P 500, which is down 9%, maybe we want some negatively correlated assets that are the opposite or less. Real estate investment trust, exchange traded fund might be somewhat negatively correlated. Treasuries would be somewhat negatively correlated and have a little less volatility. I'm not going to say utilities, but they might be doing their own thing. They can fall just as much, but they tend to be slightly up when the market's down and vice versa, because you have a big dividend. So big dividend stocks, low volatile exchange traded funds, they're a little more negatively correlated to the S&P simply because they don't have all FANG stocks making up a fourth or a third of the portfolio. And they have not been very impressive for the last 10 years, but this month we're loving them because they're not down very much. But anytime you create a portfolio for less volatility on the way down, you're going to have less growth on the way up. In the book, I have a saying, if I do my job right, you'll never beat the market long-term. On the way up, you might, and we hope to beat it on the way down, but we have to give something up a little bit. If the trend in all the popularity is moving in one direction, we shouldn't be following that 100%, maybe 25%, maybe a third, but the popularity of something that doesn't pay much in dividends can be lost, and we could lose that money for a period of time before it recovers. Non-correlated assets would be things more like gold. It's a hard asset that people emotionally feel connected to when scary times come. I don't know what's happening, but if we have a potential war starting, maybe gold starts to go up. Be careful, however, that is a commodity. And if it doesn't produce a yield, you're going to be sitting on those bars of gold or coins for quite a long time if things don't go in the right direction. So that's a legacy asset, in my opinion. If you were to buy it because you're concerned, okay. But then if the market eases on down the road and things calm down, the value might drop. That's okay if you're holding that asset for the grandchildren, because at some point there may be fears in the market that cause gold to go up a lot. I bought a gold coin for about $900 and some odd, and now gold's at I think 2,100. So one could say that was a good investment, Bill. Good for you. Pat me on the back. Well, think about when I bought it, 1979. That's been a horrible investment long term. There may have been points in there that I could have sold it, made a profit, and then it dropped after that. But I'm just saying, numismatics, collectible coins, or something else, just buy them and put them away for the grandkids. Hopefully you won't need them if there's scary times in the market. Broad parameters. A lot of us are investing for income producing funds. Income producing funds are fabulous. Those low volatility funds are in that category. Utilities, preferred stocks. Those are all great income producing types of stocks that go into funds. But again, there's a catch. If they hold long-term treasuries and high yielding stocks and interest rates are threatened to go up another 1 or 2%, they will take some major bruising. So you need to be very, very careful that if you're buying income producing stocks, they are interest sensitive. If interest rates go up and the scared investor jumps out of the market to go get a guaranteed CD, it in the future might be not 2, but 3 or 4%, that could cause the market to drop for a while. I believe those stocks will do fine, good in the long term, meaning 5 years or more. But in the short term, we want to be careful that if interest rates are scheduled to go up, your income producing stocks, thus those in the funds, could be affected. And therefore, we need diversification. We need short-term bonds instead of long-term today. Even short-term bonds are down 1%. But the long-term bonds, and we're talking about this in February 22nd, 2022, remember that date. I'm going to guess that the long-term treasuries are down about 7-8% in resale value. These are treasuries. Now you can wait 30 years and get your money back. But if you bought it a few months ago, it's possible that if you resell those treasuries individually, you could lose 7 to 8%. And that's just with a threat of interest rates going up 1%, maybe a little more. They should technically drop even further. We'll see. So right now, in this economy with low interest rates, high inflation, we're stuck. If I buy short-term bonds because I'm afraid interest rates are going to go up, or I buy CDs that don't pay anything, but I just want the government guarantee, what happens if we go up another 7% with inflation? The CD money just dropped 7%. Now it's worth 93 cents buying power on the dollar. Okay, no problem. I'm going to go over to the other side. I'm going to buy stocks that represent inflation long-term. I'm going to buy gold. I'm going to buy oil. I'm going to buy all these things. Well, what if they're at a peak and then they come crashing down? So you need to plan things out in a short-term, intermediate, long-term position, and we'll look at the portfolios a little more specifically. Dynamic factors, value versus growth. If you haven't heard these terms before, I like to relate it as to real estate. Value would be buying a small apartment complex that's paid for and filled up with people renting. It's probably not going to go up a lot in value because you're already paying the full price for it being fully rented, but at least you can buy it and just collect the income, pay cash. A growth fund is similar to buying that apartment complex, putting 20, 30% down, letting the rents pay for the building's payment, and it's not fully occupied. So that's a goal that you want to create more income in the future. So value is for those of us that are at the end of the road saying, I just want some income. Hold your value, keep up with inflation. I'm not worried about what the next big stock is. Growth is on the consumer side of let's go for it with the Netflix, the Amazon and the Google and everything else. Growth has definitely done better in the last 10 years than value, but over 50 years, value's always done better. But this next 50 years could all be growth, and we don't know. So you can't predict anything. That's why it's better for you to create a portfolio that matches your comfort levels. And those are in the following. One, we like a lot of index funds because they're low cost. They have a lot of different positions. So if one stock goes belly up, we're not going to have a problem with that. But we also have a handful of managed funds in this portfolio in areas that are somewhat dangerous. When the exchange traded funds are allowed to create a digital currency ETF, then I'd rather start with a managed fund and let somebody else worry about what to buy and where to store the passwords and things. If I'm going to buy junk bonds that are fabulous for yield, but very risky if the market goes up or down, and there's fear that their credit ratings could fall, I'd rather get a manager who can get out of some of the bonds within the fund and keep us protected from calamities. They're still going to rise and fall with the overall index, but if they can get rid of bonds in the portfolio much sooner that might run into problems down the road, that would help our downside. So index is non-managed, managed funds are obviously managed. Modern portfolio theory, you can look that up a little bit later. It talks a little bit about allocating your portfolio and trying to predict how successful it might be in the future. Good luck with that. But it does cover some elements that I think are very important. It looks at expense. Well, we know the large index funds are super cheap, and the managed funds, if they give us value in the management that they do, are not going to be cheap. They're going to charge 0.45, 0.65. I've got one that charges 0.80, but every time its sector has dropped, this darn fund has done better. So it's almost worth paying that high fee. They do derivatives and things like that to protect the downside. Now, these little areas are extremely important. Try to look at these if you're interested, or ask your advisor if you have one. Does she find these interesting? Is she extremely knowledgeable of beta? What does that mean? Beta pretty much means a historical risk and volatility. So the S&P 500 might be our benchmark. So its beta might be 1.0. Wow, big deal. Well, if I do a balanced mutual fund that isn't matching all of the S&P, just half of the fund is the S&P 500, the other half is short-term bonds, then it's a 50% in the stock market, 50% on the bonds. So what's our beta? The S&P 500 beta is 1.0. Our fund might possibly be 0.50, maybe half of the risk. I'm just saying, you can't predict it, but if we create a fund or a portfolio with several funds with a 0.50 beta, it's my hope, not a guarantee, that if the S&P's beta is 1.0, if they go up 10%, we hope to get maybe half of that. But if they crash 20%, we're hoping to only drop half as much, because we're in the nest egg and the survival mode. We're not in the gambling and predicting. And anytime you predict something, the worst thing that can happen, in my opinion, is that you're right, you win, and then now you think you know it all and you continue to gamble. You know the rest of the story. Standard deviation is kind of a misnomer. It gives you a history of volatility, the ups and the downs. The S&P 500 standard deviation might be 17, meaning an average of up 17%, down 17. Well, show me any 3 years that were the same. They're never the same, but it gives you a feel of what the roller coaster ride could be. So those are large cap stocks for the most part. The mid-sized companies or mid-cap stocks, their average volatility, because they're smaller, is about 25%. They can be up or down 25. Now, they can potentially give you more upside because they're mid-sized companies that haven't peaked out. But the standard deviation or the average volatility is much greater than large company stocks. So large company 17, mid cap or mid-size, I'm guessing at 25, let's say. And then the small cap stocks, which are not down very much. Now I'm seeing averages of around 3% when the tech stocks and the S&P are down 9, but it doesn't mean they're safer. It just means they're out of sync. They're non-correlated, let's say, or less correlated. So their average volatility in small cap stocks can be 35%. So if you're doing a large portfolio and you're worried about the future of inflation, but you don't want to be too risky, then small cap stocks might make up 3 to 5% of your portfolio, maybe 10, but you have to be aware that those little guys and gals could be down 35% when their storm comes. They're not in the middle of a storm right now. Technology is, but everybody has them. So if you're a nest egg investor and a defensive investor, we need to look at a diversified managed portfolio, not only diversified among companies, Schwab, Fidelity, Vanguard, iShares, and so on, who issue these funds, but diversified among 12 to 20 different funds. So we have some representing short-term, intermediate, long-term objectives. You can get in and out of these things within the day or a couple of days or a few days, but they have different time horizons and risk tolerances. And then in those funds, if you have 12 or 15 or 20 funds, you'll probably have 5,000 to 8,000 stocks spread out among them. You'll probably have about 20,000 bonds. So if a bond goes in default, you're not going to notice it. If a stock goes under, Apple only represented 3 or 4% of the portfolio. Obviously, they're not going under, but we don't want to put all our eggs in one basket. Now, if you're a gambler, you do, right? But we're not gamblers here. We're nest egg investors planning the future to keep us up with inflation as much as possible. but we don't want to lose a lot. So we want the upside, but I'm not here to gamble. People can ask me, Bill, what's the next best investment? All I would do is go to my charts and say, what's down a lot? Oh, look at this blockchain, crypto funds, they're down 25, 30, 40, 50%. But I have no idea whether those will rebound and this is truly a good time or not. If you're a contrarian, then you're going to stand at the top of a cliff. And I did this in March of 2020. You're going to stand at the top of a cliff and throw your money down a dark hole and wonder whether or not you made a mistake. My view is if it's the end of the world, my cash isn't going to be worth anything. So if you have some funds that are down a lot, but it's still a good, safe portfolio, but those little hedge funds like small caps or something, if they're down a lot, you need to maintain them. Remember what you've told your kids. If you bring that dog home or bring a horse home, the work starts, it doesn't end. And if you've got investments in your portfolio that could be wildly volatile, be prepared to feed them in the future. Timing the market, I'm sorry, I don't know anybody that can do it consistently. You'll see people that think they can time their markets and they, in my opinion, might have some problem. Hedge fund managers do great. Why? Because they can gamble your money. It's not their money. They may have some invested, but they can make big gambles. When they're right, they're famous. When they're wrong, we don't hear from them. The exchange traded fund gives you the ability to have several of them that represent the most conservative passive index side or the most aggressive managed hedge fund style funds out there. I wouldn't recommend them, but if you have an itching to do that, they're out there. There's probably 25,000 of them out there now. Standard deviation rolling average. If your grandkid said, hey, come on to the roller coaster ride, you would say, which has the least standard deviation? The one that has the most standard deviation in our situation is small caps. And that's like that most aggressive ride at the fair. Sharpe ratio, you'll learn a little about that, risk return, and then SEC yield. We don't have time to go into that, but that's the real yield of what you're buying at the time. The last 30 days share price versus the last year's yield, and then they divide it up, and it's a real return. You buy a new fund that says, hey, we've averaged 4%, but the SEC yield is 2.5%. That means the price has gone up, and the new buyer's going to earn 2.5 because they paid a higher price for the shares. You paid a lower price and get the same dividend. Good for you. Okay, we'll be looking at the top of the hour, a Morningstar portfolio, which will have a variety of funds in it. But stepping back, what makes the allocation objective or risk tolerance? Well, there's a lot of controversy over this because investment companies and advisors have been trying to narrow down your risk patterns. I would rather say, if I were your advisor or if you do it yourself, how do you feel about historical volatility? I can't guarantee that standard deviation and beta will predict the future, but we have some idea of where we've been in the past. I would rather say, look, you give me $100,000. We wake up tomorrow, the market crashes. It's not my fault. Are you okay with that being worth 90,000? And people go, oh, wow, okay, I guess. Okay, we wake up tomorrow and there's a war somewhere. And temporarily, the market dropped 20% or so. Are you okay with being down 20,000? Oh, and then I start to see them squirm. So then that gives me an idea that I need a diversified portfolio. I need to break it into short-term, intermediate, long-term, so I can tell them if the market crashes, you've got some money you can get out without a big loss. I need to be in dividend funds as much as possible. So when the market drops, we've got money we could get out, but don't worry, the stock funds are reinvesting. It's kind of like a sales pitch, but it's an asset allocation structure that meets the needs of the nest egg investor. Now, an aggressive investor would invest differently, and there's a lot of books out there for them. I just don't want to take the risk of losing someone's nest egg for their retirement. We can't afford that. So in the short term, we can't afford to sit in CDs because we're losing 7% a year, but we can't afford to be fully invested if the market turns around and has a bear market and we drop 20 or 30. So you'll need to create a portfolio that you're comfortable with. So let's take a look at what some of these things do. Conservative portfolio, might have 20% stocks and 80% cash and bonds. Right now, unfortunately, it would be CDs, money markets, ultra short-term bonds, maybe short-term bond funds. However, a contrarian way to look at that, Bill, the Fed just announced they're going to raise interest rates 1 or 1.5% over the next year or so. Bonds have dropped in value. Maybe you should buy more. And that's possible. So the 80% might start to be short-term bond funds, maybe some intermediate-term bond funds that are managed for risk. But we don't know where the future is going to take us. A moderate conservative portfolio might be 40% stocks, 60% cash and bonds. A lot of people argue that the 60-40 portfolio, the moderate down here, the 60-40 portfolio is dead. That's what you'll hear from a lot of advisors and things. Well, the 60-40, meaning 40% in long-term bonds, yeah, I haven't been touching those for years. I've been saying the sky's falling for, I think, about 10, 12 years when interest rates were starting to go up a little bit, but then they fell when the Fed backed off in 2018, and they were going to and all poised to raise interest rates in December, and then the market fell like 20+%. But there's nothing wrong with the market falling 20 or 30% if you're allocated appropriately, short-term, intermediate, long-term. All the funds are reinvesting dividends. You can move money at the bottom of the market. But if you buy into the fact that whoever invests your portfolio, if you, your family member, an advisor invests it and it better not drop, well, then you shouldn't be investing, in my opinion. Go buy CDs and maybe buy call options or something to help you with inflation. Be careful with that. So the 60-40 portfolio, 60% stocks. Most retirees, they're going to be blue chip stocks. They're going to be value stocks by way of an ETF fund, and they're going to be preferreds and utilities, and maybe a mixture of technology and things in there. The younger people who aren't retired, they shouldn't be in those. They should be buying on a regular basis. And if I were talking to your kids or grandkids, it would be the opposite of what I'm telling us that are near retirement, in retirement, that aren't going to be adding to the portfolios quite a bit. So the average retiree, blue chips, income producing low vol ETFs and CDs, ultra short-term bonds, maybe eke our way into intermediate term bonds. You could look at high yield, but high yield is kind of a cover for high risk because those are junk bonds. However, junk bonds aren't bad investments if they're extremely well diversified in a fund. They have a good manager, but they could drop just as much as stocks. Just be prepared. An aggressive portfolio for us retirees could be 80% stocks and 20% cash. Now, there's a big difference between 80% in technology stocks and 80% in blue chip, dividend, over the hill, staunchy, Verizon, AT&T, Procter & Gamble stocks. So I always get a kick out of people say, well, we do so much in stocks and so much in cash. Give me a break. I can reallocate these stocks of 20% and create a lot of risk. Or I can create these 80% stocks and create much less risk. So this is what the industry looks like: conservative, conservative, moderate, aggressive. But we really need to go back to the beta, the standard deviation, the Sharpe ratios that you'll see on other pages. But here you're on page 112. If you want an actual hard copy of the book, let Marcia know. We'd be happy to send one at no cost as part of the class. Okay, broad market parameters we've talked about over and over and over again. Cash is king relative to no loss in paper value, but in buying power, good luck now that we're seeing inflation at 7.5%. I haven't seen that since I started in the business in 1980, and it had started probably in 77, 78, 79. I actually watched people buy 30-year treasuries in 1978, 79. Parents bought it for somebody I knew earning 5%, and they were so proud. My parents bought me a 30-year treasury bond earning 5%. Well, what happened to that bond when rates on new treasuries went to 12, maybe 13? The resale value dropped in half or more. That person couldn't cash out. The government's not going to cash you out early. They would have had to have waited 30 years. Now, if you bought the same treasuries in 79 when they were paying 12 and locked in for 30 years. Corporate bonds can be refinanced and cash you out. Municipals can do the same thing, but treasuries don't. They don't refinance. So if you bought them in 79 or 80, you could still be earning 12% for the next 30 years. Pretty cool. So not the time to lock in long-term bonds right now, but cash in the portfolio is okay. Yes, you're losing buying power, but it would be there if you believe the market's going to fall. Or short-term bonds are there just in case. Intermediate term bonds and or balance funds if you want to do that, and then long-term stocks. You won't see them in the portfolio other than just funds that represent them. You can buy or sell them at any time. You can get in or out. If it's in a brokerage account, an exchange traded fund, buy and sell at any time, and it would take days. There's a lot of parameters to find out what to do or how to use those, because what's the volume, what's the spread between what you could sell it for and what the investor or the market maker buys it for. There's a lot of scary things. So be careful with the exchange traded funds. It's a mutual fund on steroids. So be careful. Any questions for me so far? I'm going to open it up to questions. Not hearing any questions so far. I wanted to remind you that this book you'll see in the digital form and in the hard copy. Remember, it's broken into 3 sections. Section 1's financial planning. Just skim through it and see if you have all the things checked off. Then in section 2, it teaches you how to evaluate your own mutual funds, the old ones, and see whether or not you want to keep them. You might have an old mutual fund that's started at a small dollar amount. It's worth a lot of money, but compared to others, its performance is lousy. The expense ratio is really high, but I don't encourage you to immediately sell it if it's outside of an IRA until you do a tax evaluation and see what could happen to you. It might be better to sell out over time. However, there's an argument that the tax tail should not wave the tax dog. You don't go broke taking your profits. But I'm just saying, this is educational only. I wouldn't run out and sell any old mutual funds outside of a retirement plan because you could trigger a huge capital gains. Then the argument to that is, well, so what? It's better than if you don't sell and the market crashes, then you don't have any asset value. So I'll leave that up to you and the financial advisor that you are or the advisor that you might talk to. But be careful in any of this stuff. It's like crossing the crosswalk. Look both ways first. Okay, portfolio parameters. There are a variety of things in a portfolio. So you walk into Schwab or you walk into Fidelity. I don't know if Vanguard has any public places, but you call Vanguard, get online, all these other companies. You can create a brokerage account under the name of your IRA, under the name of your individual name, under the name of you and a partner, joint tenancy, under the name of your community property, or under the name of your trust. If you have a trust, it's a good idea to have your non-retirement plan in the name of the trust. If it's a retirement plan, then it's in your name. And rather the trust, most often, it's better to have, obviously, a spouse be the first beneficiary. There's a million things why that's a good idea. But if there is no spouse, adult beneficiaries there. If you have grandkids that you want to inherit your large IRA, but you don't trust them, you can set up an IRA trust. It's a legacy IRA trust, where when you die, the money goes to the trust for the benefit of the children, and then they have 10 years to pull it out. But if it just goes to the trust, you have to pull the money out in a year. And who wants to have a trust pay a bunch of taxes? We don't have time for that, but consider that when you set up this brokerage account, make sure you do the registration properly. And then in the brokerage account, you can buy individual stocks, individual bonds. You can buy individual mutual funds issued by the mutual fund company at the end of the day, or you can buy an exchange traded mutual fund that you can buy in the moment. And whether or not there's a lot of other buyers and sellers will determine whether it sells immediately and whether you get a fair price. That's a problem, because if you put something up for auction at the auction and there's not many buyers, the price could drop quite a bit, and the auctioneer is going to have their spread no matter what. So when you go to Uncle Schwab or Vanguard and Fidelity and all these other companies, they're not there for free. They might advertise that they will let you buy and sell for no ticket charge, no $5 or $7. We don't do that. Schwab came out with that. Vanguard had it earlier. Schwab came out with it to bring TD Ameritrade down, in my opinion. And then Schwab, because Schwab makes most of its money lending money more like a bank, and they'll lend your stocks and make money for themselves. But TD Ameritrade was there for the consumer, and they were charging a ticket charge. But when Schwab eliminated theirs, TD Ameritrade lost a lot of share price because people are worried. How are you going to stay afloat without charging a ticket charge? And Uncle Schwab swooped in and bought them out. So that's the hard world of investing. You create this brokerage account. You won't have a ticket charge to buy or sell most things. There may be some funds that are hostile to them. Maybe there's a Schwab brokerage account and you don't want a Vanguard exchange traded fund where Schwab would make a spread on it. You want the Vanguard mutual fund where Schwab wouldn't make any money and Vanguard's not paying Schwab to be on their platform. Well, they're going to charge you $10, $15 to go buy that Vanguard fund. So if you go do it yourself, ask, do I pay a ticket charge? It's not the end of the world. But if that fund company doesn't pay to be on the platform, then they're going to charge you, because Vanguard is known for not paying fees to be on other people's brokerage accounts for their funds. Now, you can buy Vanguard's exchange traded fund because there's a little spread, 1 penny or 2 pennies or something that the brokerage company will make. So that's going to happen. So when we are ready to put this together in a brokerage account, we're going to look at all these other companies. The asset allocations are important. How much is cash, bonds, and stocks at the end of the day when you squeeze all these funds through a blender? Sector weightings. I don't want any one sector, meaning all tech, all utilities, all gold, all anything. I want them spread out, but I want to know, am I overly weighted in one of the sectors? And there are programs that you can run that through and see. What's my cash balance? Do I have enough there in cash just in case the market drops or I have an emergency? But again, cash is dying by 7% a year. But then again, you turn around and buy stocks, they could drop, hopefully temporarily, 20%. So I guess that's an argument for the stock. Sooner or later, hopefully, historically, they've come back. If cash drops 7% with inflation, it may or may not regain its value. I don't know, but very short-term money, just tolerate the cash, in my opinion. Total stocks inside the portfolio, when you run a program and squeeze all the funds through a blender, like I said, 3,000 to 5,000 maybe, and 20,000 bonds. Equity versus fixed income. Equity just means stock-related funds, ownership of the companies, and fixed income just means things that you buy for the fixed income or the dividend. And they've been hit pretty bad recently. I knew this was coming. It just took 10 years. So all those years I've been crying wolf. Finally, that happens. And even the short-term bond funds that I might have clients that are down 1.5% or so. But if I strictly went to cash, I wouldn't be earning 1.5% or 2%. So nobody has the perfect answer when you're trying to diversify. And also keep in mind, these bonds, these stocks that are in these exchange traded mutual funds are publicly traded. That's good. They're regulated by the Securities Exchange Commission. That's good. But you're getting them after they've gone public. So you're not getting the super cheap price like a venture capitalist or an angel investor or someone else. But also they lose a substantial amount of investments that don't go anywhere. We're paying for the luxury of having liquidity, diversification, and regulation. No guarantees, but we're paying for that luxury. So we're not looking for something to pop 100% overnight. That could be quite dangerous for us. We want to look at the historical 3-month, 1-year, 3-year, 5-year, and 10-year performances just to get some idea. Now, if you're a contrarian, you're looking for those to be negative, but a really good fund. It just hasn't had its day. Low expense ratio, 5 out of 5 stars based on Morningstar's previous rankings performance compared to other funds. And there's no guarantee, but they do give metal ratings, gold, silver, bronze. That's just their opinion, doesn't guarantee anything. But you might want it to have horrible returns if that sector was down a lot. If it's a bad fund and it's got a negative rating and a 1-star, sure, I wouldn't go there at all. Total number of funds in the portfolio. I usually go 10 to 15. If it's a really big portfolio, maybe 20. There's no guarantee. Nobody knows what the right number of funds are. If you absolutely don't like that concept, you can buy a balanced index fund with one of the big companies, and they have a ton of bonds and stocks in it. The half of the stocks is relative to the S&P 500. The other half of the bonds is total market index. Well, what's the problem with that? S&P 500 is mostly tech stocks. Boom. However, could be a good time to buy now. I don't know. The bonds have represented total bond market, which means it's got long-term treasury bonds and corporate bonds in it. I don't like long-term. Then again, the other thing on my shoulder, the angel on my shoulder says, Bill, tech stocks are down. Bonds just took a hit. Maybe it's time to buy. What do I know? Because I can't predict what 100 million traders and algorithms and computer programs will do tomorrow. So we come back to what's right for me, what's right for you, not what's right for everybody else. Be very careful and stand your ground. If somebody's trying to talk you into something you're not comfortable with, you're more apt to cash out when it tanks than if it were your idea. Total number of funds in the portfolio I mentioned, the risk. The rolling average standard deviation is not a guarantee, but it gives us an idea of averages. And you can look at the beta we'll talk about. Historical 3, 5, 10, and 15 years of standard deviation, not just return. Average those out. We mentioned beta. Most people that are retired like a beta of about half or a little less than half of the market. That means they got to give up some return with some short-term cash positions. Preferred stocks have their own risk if interest rates go up a lot, but they tend to not be as risky if you're looking for a 5.5% dividend. So if your preferred stocks drop 5.5, but earn 5.5, it's a healing process that can occur if you leave it alone and let it reinvest over time. No guarantees, but in 5 years, if you have a 5% yielding preferred stock exchange traded fund, you've earned 25% of the original investment back in dividends. That might take some of the downside sting out of it. I'm just saying, every portfolio is different. Alpha, that is a performance number that says, compared to all the other funds or all the other portfolios with the same beta, say our beta is 0.50. Not a guarantee going forward, but we're hoping that we're half as risky as the stock market. Well, we can run an analysis and see if our portfolio has a good alpha. And that alpha means, compared to other portfolios with the same beta risk, how much better or worse have we done? Now, I hope to do portfolios that are better by a half, 1 or 1.5% better, mainly because we look at low cost funds. That's helpful. But hopefully we pick the funds that are more defensive. So we want to have an alpha that is better than other portfolios with the same beta. We get a better rate of return for the same risk. And that's kind of like a Sharpe ratio, risk return type thing. R square is just telling us our portfolio, how similar to that is that to the overall market. So we want to be a little dissimilar. We don't want to be 100% the same as the overall stock market and bond market. We want to be 95, 90. I've got some clients down to 80 something, where you might have alternative investments. Which brings up another point. Alternative investments are big in the news. They represent gold and silver and oil and real estate primarily, and art and all this stuff. There's always a time where they'll do pretty well when everything's not doing that well. So it's not a bad idea to have some alternative exchange traded funds that you can get in and out of quickly in your portfolio. Not a bad idea. 5%, 10%, maybe 20%. But at least they're regulated, they're diversified, and they're liquid. I would stay away from the steak dinners. They have the best looking steaks I've ever seen, but unfortunately I've been a vegetarian since 78. So, but I would stay away from any too good to be true, free dinners and all that stuff. The only dinner I would go to would be if you work with a CPA, an attorney, or an advisor, and they have a dinner for their clients and it's an appreciation dinner for those who have already worked with them, fine. Eat it up, have 2 steak dinners. You're paying for it. But those that are having those little seminars and stuff, I would run the other way. Insurance products, non-traded real estate deals that, in my opinion, are loaded up with 10, 15, 20% fees and commissions, I would stay away from that kind of stuff. Insurance, I would also stay away from. An insurance annuity when they give you any return, they have to go out in the open market and invest the money to get a return for their general investment portfolio. So they're going to be buying ultra short-term bonds, CDs, treasuries, mortgages, maybe preferred stocks. And now they've got to eke out a return to you. And then some of that money buys options that if the stock market goes up, you'll make money. But guess what? You might only make half. They keep the other half. So why give them all the money to invest? You can create your own annuity on your own with T-bills or CDs with buying options if you want. R-square and then combined yields. Obviously, do we have a good yield? Young people that are investing each month, they don't need yields. If their funds drop, they're going to buy again at a discount. They don't need yields to bail them out. We need yields to bail us out. If the market tanks, I'll tell my clients, look, they're down 10, you're down 4, hopefully. That's good, bragging rights, but that's only a part of the sales pitch. We're reinvesting dividends on all the bond funds to cash, and then we're reinvesting that cash and the funds themselves to the stocks. So we're dollar cost averaging. Isn't that good? Try to make you feel better. Pat you on the hand. And then the other thing is we have the short-term, intermediate, long-term liquidation provision. So when the market tanks big time, that's when hopefully a conservative portfolio looks really good. Now, long-term, it might fall behind in growth, but we want not to sink. So we create a portfolio that's conservative. Now, if you disagree with me, you can reverse these values and you can have an aggressive portfolio with a high beta. You want a 1 plus 0.25, 1.5, 2 beta. You can do that. I have a couple of funds in my portfolio. Energy funds have a positive beta, so they can be a lot more risky, and you could add them to the portfolio. But yields are usually good because it gives us an immediate reinvestment process when things drop. And or if you have a lot of money there and you don't want to sell anything, you might be able to live off 2-3% if you have enough portfolio. Combined funds, and there's a program that I use with Morningstar that combines all the funds, and it tells me the average expense ratio. So if I did buy that 0.80 preferred stock fund that's always, in my opinion, protected us on the way down, but I cringe, but I have all these other low cost funds, my average expense ratio might be 0.25, 0.29 or something, and bring the overall average. And remember the pyramid we talked about in 3 layers: the base of the pyramid, total market index funds, and maybe an S&P index fund, where they're massive in size, big giant companies, and the expense ratio is quite low. And that's where maybe most of your funds are placed. Then the middle part of the pyramid are the specialized small cap versus mid cap versus large versus sector index funds, and the allocated index funds that they rebalance once a quarter, once a year, and then some of the passively managed exchange traded funds. Then the top of the pyramid, the last third, which is the smallest, that's where we would put this high cost preferred stock fund, high cost junk bond fund, ones that really have a history of not falling as much when things get ugly. So I believe that I pay management to keep us protected on the downside, not 100%, but reduce the downside, right? Because we can all go buy an index fund tomorrow. I'm going to buy small cap index. I'm going to buy technology, and anybody can guess. You don't need managers to do that. But on the way down, I would like to have some help. So this is information that we need to put together. Additional information, I mentioned portfolio account registration. Please, and another time, please go back and look at your accounts. If you have a trust, IRAs should still be in your name and your spouse's name with human beings as beneficiaries, usually, unless they're really young. You can do an IRA trust. That aside, your house, your non-retirement investments, stocks, bonds, brokerage accounts, funds, whatever, other real estate holdings should be in the name of your trust if you have one. And then learn the difference between ownership. If you have things in a joint tenancy, the book will tell you somewhere around page 119 that if you leave all your rentals to your spouse, he or she may have a tax problem when they go to sell them because they inherit your half tax-free, but not theirs. They pay taxes from the original purchase price to the price they sell it for. We don't have time to go into it, but be aware of that or read into the book about that. Check beneficiary designations on anything. If you have beneficiary designations, make sure that you know who they are. I had a spouse recently. She unfortunately passed away at a young 50s. Her father was the beneficiary of a very large IRA. She's been married 25 years. The husband's going to be aced out. The father had passed away. Okay, now her sister was the beneficiary. But she had received several times beneficiary forms to put her husband on and remove the other people, and she never sent them in. So now the sister is the beneficiary, and she's going to have to decide to sign off and let the husband take over, or he's not going to see those dollars. So make sure you understand who the beneficiaries are and what your logic for that is. Track the mandatory distribution. We all know that it used to be 70.5. Now it's been moved up to 72. Some of you might want to, if you're under that age, start drawing now to let some air out of the tire, or instead of just draw it out, maybe convert to a Roth. That sounds like a pretty cool concept. But remember, if you want to live a tax-free retirement someday with big Roth and a giant whole life insurance policy where you borrow out your own cash value and the insurance company makes money, and you borrow on your real estate and live off that and let the kids get all this stuff without any capital gains, that's fine. But remember, these people selling things on the radio saying you're going to live this way, they didn't tell you that in order to have this gigantic Roth, you had to convert from a regular retirement plan to a Roth unless you worked in a 401k, and that's a possibility, but most of us haven't. So they don't remind you that you got to convert 200,000 in a rollover IRA to a Roth. That's 200,000 more taxable of that income that year for income on the state, the Fed, and if you're drawing, if you do Medicare, it's going to go up. So that could harm you quite badly. So be careful. Work with your accountant or an advisor on that case. But if it sounds too good to be true, it usually is. It isn't a bad idea to start drawing money out early and converting what you can afford tax-wise, you have cash on the side, and create a bigger Roth. Why? Because that Roth doesn't demand that you keep pulling money out in the future, so you can average out your taxes, manage that, and also that your beneficiaries, when they liquidate that money, don't pay taxes on it. And they'll have to start pulling that money out over a short period of time. I think it's 5 to 10 years or so, but there's no free lunch. Please look up whatever somebody's selling on the radio, and I'd be very, very cautious. There's also advertisements of advisors talking about all this financial planning. Then by the time they get you in the office, they direct you to these great index annuities. And I don't have time to talk about those, but I wouldn't do that. Anytime somebody wants to give you something that's too good to be true, I would run the other way. We need the exercise. Oh, by the way, the 72.5, a big sales point that people in my business or brokers and everybody says, oh my gosh, if you don't pull money out at 72, are you pulling your mandatory distributions? Most people are. The companies have taken that responsibility on to keep bugging you. But if you don't, the penalty is 50% of what you didn't pull out. So that's a big deal, but that's a big scary sales point in the seminar. So just wave that on. You're doing it or you're going to do it. It's not a big deal. If you're not that age yet, see your accountant. Maybe some Roth conversions are good. Post-diagnostics, we've looked at the portfolios being part of the diagnostic process. After we've done section 1 of the book on the financial planning and the diagnostic reviews, and then in the second part of the book, we've done the portfolio diagnostic, either updated your portfolios or created new ones that fit what your needs are, then you need to look at the post diagnostics to get ready to continue into the future. So I'm going to skip through these fairly quickly and we'll get to the Morningstar sheet. But do look at on page 121, the post diagnostic, once you've done all this stuff, because what's the point of doing investing and making a lot of money, and then all of a sudden you didn't have the right insurance when something happened, you got sued, the insurance company wrote their check, now they come after your investments. And some are protected, some are not, I assume. Look through all the insurances, the umbrellas, the trust, the attorney, power of attorney, all these things, and update these on an ongoing basis. because when we do that, after we've done everything, then we want to continue to review these things on a regular basis. There's tons of them. We don't have all this time, but if you want to do this yourself, you have nothing else to do. Now you have a life, because you're going to be busy doing this stuff all the time. And if you love it and you like to get things done, go for it. Save the money of hiring an advisor. If you don't want to do these things and you say, look, I'm going to pay an advisor 1+% a year to manage my assets, and I'm going to get all this for free because I'm going to use her back office and stuff, good for you. That's your choice. But please review each of them and make sure that you're doing them, whether you do it, your partner or a family member does it, or you hire a CPA, an attorney, or a financial advisor. Post punch list, that means after you've completed the financial planning diagnostics, you've created a new portfolio and you're all set and you found the new funds that you want to find, and you've done your estate plan. We need to monitor things into the future. And the third part of the book talks about monitoring those things. But the first thing is you look at the post punch list to make sure you're still working on getting those other things done. I might recommend somebody see their attorney, do a trust, and a year later, they never got around to it. I'll do a post punch list review once a year and try to get them up to speed and get them to do it. If you're not into it, it's boring as anything. Like the lady who didn't sign the change of beneficiary form, her husband could be aced out of those dollars simply because she didn't want to bother with it. Okay, I'm going to bring over here, hopefully we can see this, the Morningstar page. It's going to be small print. I don't control the size, but we'll do the best we can. Okay, I had the market fall today just so you could get some experience of this page, because before it was green. So of course I control the markets, right? Ha, ha, ha. Today, the market's down 600 points, 1.8% on the Dow. These little columns here tell me value stocks, small and mid, are down, but the large company value stocks are down less. And then the core growth and value stocks, and then the growth stocks are down significantly. So they're down more. So if you had all your money in large cap value stocks, you would be down less than if you have large cap growth stocks. We talked about that. Let's take a look at a portfolio. We talked about balance before, but I'll look at growth and income this time. Here's a big list of funds. They're very small to see. The first one has a fund called Cohen & Steers Preferred Stocks. But the hope here is that the dividends are available to reinvest over time. This particular fund has preferred stocks in it that pay a lot in yield, but they're preferred stocks. Preferred stocks are kind of like bonds that might have a little edge on the way up for appreciation if people like it. This particular fund, Cohen & Steers Preferred Stock, it's got 5 stars out of 5 stars, meaning it's in the top 90 to 100% of funds like it for the last, I'm assuming, 10 years. And then Morningstar gives it a silver rating. The Q stands for quantitative. That's their computer algorithm giving them a silver rating. Normally, individual managers and analysts do, but they've expanded it. Obviously, they're scaling their business. But check this out. Expense ratio, 0.85. That's high. But what are we getting in return? Well, we're getting good analysis. The process is considered high, good. The people are considered good, and the parent company is above average. And so we're getting that in return. But here's what we're looking at. They're down a bit recently, but their performance, if we just went to the stock index, preferred stock index, 10 years later, we have 17,732. This company, you've got 20,683 after their expense ratio. So it might be that a fund that has a high expense ratio might be earning their weight in fee. Now, here's year to date. The stock market's was down 9.3. It's going to be a lot more after today, but it was only down 4.31. So we're getting less than half as much. So I'm not claiming that preferred stocks are the only way to go. They are interest rate sensitive, but in this case, even when they fall, had you bought them a while ago, you were getting 4.90. The relative yield today relative to the price is almost 3%, a little bit less. Either the yields come down or the price has gone up. Now, here's, I'll go to the opposite end of this, Vanguard Mega Cap Value Fund. Mega is just bigger, bigger, bigger. They're in the top 5%, and it gets a silver rating without a Q next to it, which means the analysts have physically looked at it. Its yield, because it's a value stock, is 2.19 or 2.20. The price has dropped a little bit so that you buy a cheaper price for the same yield, so it equates to a little higher return. Expense ratio 0.07. That's what I'm talking about. This is an index fund. They're not doing anything. They're buying one of everything. So if they crash in value, it's not Vanguard's fault. But their expense ratio 0.07. They have a decent yield. That's a fund one could buy and just let it go and let it reinvest. But it is value, mega value, meaning huge companies. If my software will, okay, here's the red is the index and the Vanguard fund is in the blue. So its job is just simply to follow the index. Don't do any better, don't do any worse. It will technically do slightly worse by 0.07 its expense ratio, which you can't even see, or maybe they have to hold a tiny bit of cash and they're not fully invested. But the good thing about exchange traded funds is they are usually fully invested, where a mutual fund has to retain a bunch of cash in case somebody wants out. They have to buy it. Where if it's a Vanguard exchange traded fund, Vanguard doesn't lose any sleep over this. If you want to sell it, you put it in the open market. Some other investor has to buy it, or there's somebody called the market maker who, if there's not enough liquidity, will buy it, but it might be at a lower price. Year to date, mega cap 2.42. Go figure. Their standard deviation is 25 over 17 compared to the big stocks. But the big stocks, or the index, meaning more tech stocks, are taking a major beating. But here we are, Friday. Today we're probably down another 1 or 2%. Who knows? But as of Friday, they're only down 2.4 versus 9.3. So at unusual circumstances and times, the small cap, the mid cap have actually propped up your portfolio, and we haven't dropped as much. But on the long term, they can be very volatile. So I'm not going to say use small and mid caps for safety, but they are a good non-correlated asset to that S&P 500. Here's a Vanguard international fund. We sprinkle international funds in maybe 5, 8, 10%, simply because they're not the US. The US has tended to be pretty overpriced. We're not going to get a chart there, I guess. 4.21 is the yield because these are bigger dividend paying funds. Now, here we are, we're an international high dividend index fund. So if you think I'm going to load up more on the international, which is the thought of a lot of analysts, maybe it's time to start going much more international. You'll hear on Bloomberg and that. They're looking for high dividends. So if they don't pan out, at least you get a huge yield. Look at this, 4.21. So consider it to be like a bond with a lot of downside, but as well some upside inflation potential protection. But it's an index fund. So even with that, the expense ratio with Vanguard is 0.28 because they've got to do some, I don't know, balancing or looking for taking extra effort to buy the stocks that are in that index. If this computer works, Vanguard's underperformed its index, but I wouldn't hold that against Vanguard. It's possible. I don't know. We'll take a look at the risk measures here. We'll see if they're the same risk. They are just as much as their category. Standard deviation is slightly more. So I'd have to dig into this and find out why the risk. Although Morningstar says its risk is about average and then its performance is above average, so not bad. But if I was going to buy a fund here and just buy it and forget it, but I wanted mid caps, I would like this fund because it's got a high dividend, low expense, and I trust what Vanguard's doing. More of its positions are in financials than the index itself. So it's not going to be allocated exactly the same as its category. Here's its category, but it goes further into financials. and less into industrials and so on. So I'm going to guess that in the last few years, it's probably done better than its index, but we'll get back to that. So here's the companies: Nestle's, Toyota, Roche, Shell, and many other companies you might recognize. You also will see that there's 1,194 positions, 0 bonds. So if I were just looking at this portfolio, I'm fairly impressed, especially with relatively lower cost. I did want to go back and see the last 3 years or fewer years. So here's the index down here. Okay, index is down 1.5, but this fund's up 12.5. So the fund has done better in the most recent years because it's gone more into financials in different sectors than the category. So that's why we're seeing them below. And although it's still below in the long term, starting from year 1 to year 10, look at how they've gone up in this period of time versus the index has gone down. So more recently, their allocations have panned out. But if it's a big index fund, I don't have a problem if it's a big index fund with a Vanguard, a Fidelity, a Schwab, iShares. There's several others out there that would be mad at me for not saying the names, but if it's an index passive, buy and do nothing, I'd rather be with the big companies and the lowest cost. But this fund, they've had to do some maneuvering, let's say. Their expense ratio is 0.28, which normally we would think that is high, but for the average in the industry, that's not. There's $3.7 billion there. So for those of you that are retired engineers, you'll love all these numbers. They're really kind of cool. I can't keep up with them. There's always something different. Here's a Invesco preferred stock fund. This one buys preferred stocks. It will undoubtedly be down. Its yearly 12-month yield is 4.35, and the last 30 days is 3.9, let's say, closer to 4. Neutral and neutral ratings. Okay, but the word variable in here catches my eye. Variable rate. I like the idea of preferred stocks that pay variable rates, because if interest rates go up and stay up, we're gonna tank big time, because our 4-point yield in a year or so might have to compete with 5 or 6 on new funds that have rates that are higher. So the price would drop. This is a variable rate fund. And so I'm hoping that they'll give us just a little bit less on the downside. I don't know if you can see that, but this little tail is slightly less than the index itself. I don't expect to perform the same because we're variable rate, but year to date, it's down 4.29 compared to 9% overall in the market. And its index is down 6.34. So if you go to PFF, I think it is, there's an ETF that's preferred stocks. It's an index of all preferred stocks. This one buys variable rate preferreds. That other index is down 6.34. Our fund is only 4.29 on the downside. That's a big difference. And this means that we're more defensive against interest rates rising because we have preferred stocks that can fluctuate. They can update their returns. That's boring for a lot of you people, but let's just go to a Schwab dividend equity. Again, the portfolios that I work with are more value or more dividend oriented for the reasons I mentioned. This fund pays 2.86 if you've had it for a year, but the SEC 30-day yield, if you just bought this fund at a discount, that inversely means you're going to earn more, 3.04. So that's kind of cool. The 30-day yield is better for you now that prices have dropped. $30 billion with a B, 0.06 lower than some of the other competitors, but it is, and they don't have the name index fund on it, but I'm assuming it's passively managed and it buys one of their own, they create their own index. And so see how they pick different positions than its index. They've done much better on the upside because I think this is more of a broad market. It's going to have some of the stocks in the S&P. If I can scroll here. Before I get there, it has average risk according to Morningstar and high return. That's good. Standard deviation of 18.13 versus category of 19, and then the index is about the same. So the risk level down here, the worse that it was, these are other areas if you can find or get access to these. How did the investments do during various times? Well, between January 1 and March 31, this fund dropped 21%. Ouch. But the index was down 25 because the stocks in this fund are not as techy or not as momentumous, if that's a word. 99% US stocks, and they're all large cap value. So we know that we don't have growth stocks in it, and we're just lucky right now. And look at this price earnings ratio, 13.8. The average stocks in the stock market, S&P 500, are probably 22 to 25. What does that mean? Well, if I buy a share, let's say at $13.85, then I earn $1 dividend. So it's 13.85 times that $1. Well, the S&P 500, I'm guessing you have to pay 25 times that $1. So people are saying the S&P is way overpriced. That's possible. But in this fund, you've been buying stocks that are possibly underpriced. They haven't been impressive until recently. Heavier position, that black mark is its category and index. And financials, heavier position in industrials, technology, and consumer defensive. Less in utilities, less in real estate. 101 stocks, and no surprise, oops, the old staunchy stocks, Coca-Cola, oh, big deal. They've been around forever, but they're more stable, possibly have a better dividend. Verizon, same complaint. I'm not going to get rich on Verizon, Merck, Amgen, Pepsi-Cola, Cisco, Pfizer, IBM, Texas Instruments. Those are, you could say they're has-beens, but they sure are nice to pay a dividend, give us some inflation hedge, and possibly be up when everybody else is down. And they're going to give us some inflation hedge with a dividend, which might mean that people want stocks like those more than they do some tech stock that might pay them a dividend someday. I'm just saying. JP Morgan. And by the way, Cohen and Steers, Vanguard, you'll see SPDR is State Street, T. Rowe Price, Fidelity's in there, JP Morgan. Remember, our first rule, if you follow this book, is to not have all your eggs with one company. So I don't want all my eggs with JP Morgan or Vanguard or Fidelity or Schwab for reasons I can't think of. Maybe hacking, maybe something terrible, but I don't want all my eggs there. Now, the information will come back to whoever your brokerage account is with, be it Schwab, Fidelity. I use National Financial, which is owned by Fidelity. It's well diversified, but still in one location where you get your statement of these different funds because the money's held with a fund company. So I want another fund, JP Morgan. I've had a hard time finding the funds I want because this fund is only neutral rated, but it is a gold rating as far as Morningstar's quantitative computer analysis, but it has an expense ratio of 0.12, and that's good enough. I like that. Its yield is 3%. Now these are, looks like it's probably more mid-cap, so don't just buy the yield. You could run into a problem, but if you're looking at yield and more upside potential, this fund has followed its index quite well, so I'm impressed so far. Year to date, look at that. As of Friday, it's only down 2.26. That's only because it's non-correlated to the S&P 500 because it probably doesn't have a bunch of tech stocks in it, and they're mid-sized companies. So again, don't think that you can go buy a wad of this fund and you're going to be safe. This time you are safe because it's non-correlated to what's going down. Next time, its category could drop, and if you can ride out the other side and add to it and let its 3% dividend reinvest, fabulous. But if you needed to cash out on a fund like this, don't be mistaken with this little downside of 2.25% versus 9.3. One day, this fund will have a bad day. and it goes in the long-term bucket. No problem. If it has a bad day, what do you tell yourself? What do you tell your spouse? What do you tell your kids? We're earning 3%. What do I care if the fund's down 15? Let it reinvest. It's in the long-term imaginary bucket. So that's money I wasn't going to touch anyway. As a matter of fact, I'm going to move some cash over. Don't get fooled by what looks good today, because it will have its bad day. Trust me, if I can say anything, it will have its bad day. Here's a fund I'm intrigued with. I have not used it. I'm not encouraging you to buy it. I'm just intrigued. iShare Emerging Markets Dividend, 2-star, but I don't know that it has anything to compare it to. It's a silver rating quantitatively, 859 million. Expense ratio is 0.49. Okay, I would expect that. Look at the yield, 7.29. That's amazing. How are they getting that? Well, I haven't analyzed this very much, but obviously a lot of the emerging market companies, if they have bonds, they pay higher rates of interest. And if they have stocks, they might be a higher rate of a yield. Today, the fund's down 2.62, and it was down a lot. So I wouldn't run out and buy a fund like this. The software gives me problems. Okay, here we go. See how it runs away from me? Come back. Let's see if I can get any other numbers. I thought it was year to date down a lot more than that. 3.5. I don't know. There's some reason for that 7% yield and being down 2%, 2.5% today. That's a lot. But some people argue that emerging markets look really good because there's a lot of growth on the upside. But again, if you play with something like that, maybe consider it being 1 or 2 or 3% and put it on the level of Bitcoin and a digital currency when those are allowed to be sold in an exchange traded versions. They're not yet. It's okay, have a little bit, but just be very, very careful. Or if that fund drops a lot, I don't know how it's earning the 7. Look up, Google it and find an analysis on it. I'll go back and start looking at it, but see, how are you making 7? One way a fund can make extra cash flow, and they can do quite well when the market's flat or starting to move up a little bit, they'll buy 80% of some stocks that everybody wants. Let's say the S&P 500. And then the other 20%, they will keep in derivatives like call options if the market goes up, but they'll also sell call options and earn money from people wanting to buy it. So let's say your house is up a lot and your neighbor says, I want to buy your house someday, but I'm not ready to buy it today. I just think the market's going to go up. So he or she gives you $10,000 a year for the option to buy your house at today's price. And if several years go by and it doesn't go up, joke's on them. If it does go up a lot in value, joke's on you, you have to sell your house. A lot of these funds that have a high yield, be careful that they're selling options on the internal stocks. And if the stocks go up a little bit or a lot, they have to sell them the stock at an old price, take the cash and go buy another. But they still own the stock. So if the market crashes, that call option money that your neighbor gave you each year is nice to have. But if your house went from 600 to 400, you still dropped. So be careful when you have a huge yield. There's always a reason for that. It's not a bad reason, but it could be something to catch you. Here's a fund I'm going to show and be our last one because I need to show you the portfolio. This is a Invesco. It's a big exchange traded company. They start out with new exchange traded funds that the big companies don't want to waste their time with because they don't know enough money's going to come there. So these funds will start this new concept of how do we hedge the downside, probably with derivatives and put options and things like that. Their expense ratio is 0.40, which is actually pretty good if they're going to give us protection on the way down. We'll see. And the dollar amount is 384 million. There's not a lot of money. So remember in your training, if there's not much money in the fund and you go to sell it, there might not be a buyer or buyers that will pay you that so much $1 a share. You might have to drop the sell price. Okay, now this fund has not gone up a lot, but it possibly hasn't fallen a lot. So we've given up upside growth potential for whatever it is they're doing to hedge the downside. Let's see if the downside hedge was worth it. Let's see if this little thing on the computer is going to let me do it. Okay, I don't know. Yield year to date, 3.94. Well, wait a minute. We gave up upside growth. We earned practically nothing compared to being fully invested, and we're down 3.94. Okay, this is like a big soap opera. Look at your funds. I'm not seeing the value of this fund in the year to date, and this month or 3 months down 2.6. We'll have to see what happens. But is it worth getting a very low return and less downside? Well, I don't think so, because had we had some small cap, mid cap value, had we had a large cap value funds, had we diversified properly, we're probably overall down that much without having to give up the upside growth potential. So it's not a buy or a sell recommendation. I don't do that, but you got to look in a little deeper and figure out what's going on. I came out of the chart, but in March of 2020, you would have loved that fund because it didn't drop much at all. And again, if I do my job right, I'll never beat the market consistently on the way up because I padded the portfolio with some CDs, cash, short-term, ultra short-term bonds. I padded it with Jenny Mays that slowly update and downgrade their yields. I padded it with non-performing preferreds. They give me a big yield, but I don't make a fortune on them. So do you want a safe car with a seatbelt and an airbag? Or if you could buy a car without those things with a less cost? Fortunately, they don't let us do that, but you've got to look in the past, but also assume that the past is no indication of the future. None at all. Market's down 600 points. That's a lot. We need it, but nobody wants it. I don't want to see that happen. Okay, I was going to go over here to the portfolio. And while that's waiting to come up, if you're a person that has disdain for portfolio managers, then all you really need to do is have like 3 or 4 different index funds. Short-term bond index fund used to be total market, but I wouldn't do it now. Total stock market index, S&P 500 index, global or international index, a 4th or whatever allocation you want. You could drop those in and not worry about it. But we've seen, however, that the index funds don't always protect us on the way down. So if you want something to give you a little bit more protection, you might want to utilize something that can do that. So in my opinion, and you'll read this in the book, long term, if I could put you in a time capsule and wake up in 50 years, a total market index fund, stocks, fine. In my opinion, you'd probably do better. I might even go a little more aggressive. Total small cap growth index and wake up in 50 years. That'll probably knock your socks off because you've got 50 years for the ebb and the flow. But if we've only got 10 years before we start drawing on this stuff, and we might have 10 or 20 years to live or 30 years, we don't want to lose stuff on the way down. We can't wait for. So short-term, intermediate, long-term bucket, that's fine, but we've got to balance a portfolio. So let's take a look at this growth and income portfolio, see what it looks like. This might be more aggressive than most people like. We'll see. It's going to match up the New York Stock Exchange composite, meaning all of the stocks on the New York Stock Exchange, not just the tech stocks. So it will not grow nearly as much as the S&P 500 because it's not overweighted all in Apple or something. There shouldn't be any bonds in there. So most of everything, these little boxes are, this word says large. So there's 32% in large value, blue chips. There's 16% in large growth, Amazon, technology, and then 27% a mixture of those. They have mid cap and then about 3% in value and blend small caps. Notice not a lot of stocks here because we want the value positions to hold up if the market drops. We're willing to give up some upside. Don't have time here, but you can look at the areas that they're invested in and the geographic locations. Portfolio snapshot, we're in the yellow line. We have all of our funds that are different than the New York Stock Exchange and reinvesting. And the blue line shows the New York Stock Exchange. I don't think they're reinvesting, so it's not a fair comparison. They probably would be slightly higher than us, but it is what it is. When we fell here, we fell less than, if you took it from the high point to the down point, less than all stocks because we have some bonds in there and things. The average return on this portfolio is 9.7 and compared to the benchmark 7.83, but I would say we'd probably be similar if they were reinvesting. Worst case scenario, I don't care about the best case. Here's the best case, but here's the worst case. We were down 15.19% in March of 2020 when the stock market dropped 38 and then it leveled down to about 25%. So we're down considerably less. But still, it was a scary ride. That's when you pat yourself on the back and say, we're not down as much. They're down 25, we're down 15. That should encourage you to hold on and maybe reallocate into those positions that were down the most. Don't follow the crowd, follow your intuition and your needs. The crowd has already bid things up high. We saw that with GameStop and that. If you're a psychologist and you think you can time the crowd's emotions, well, I guess that might be a fair bet, but I wouldn't do it. This little chart here, when you put 15 funds in a portfolio and they're all mixed in together, these green dots are individual funds. So you'll see one fund is no risk at all, but no return. And then whatever this one is has the highest upside gain, but it's farther out on the diving board. This is steps to the diving board, the base of the diving board, and this is the springiest part. We're here a little more than halfway out on the diving board at about a 9% volatility. And then the overall stock exchange had a volatility of over 13. If we look at standard deviation in years, 3 years, 5 years, 10 years, let's go 10, our average volatility is 8.76, where the market itself is almost twice as much, or 13.42. The average return 9.7, their average return 7.83. Short term, our average return 12.9, other stocks 10.65. Now remember, beta gives us our average risk compared to the overall market. I'm thinking S&P. So we have a 0.63% or 0.63 beta. I would expect that if they drop 10, the S&P, I'm hoping we only drop 6.3. No guarantee, but it's the best we can do. It gives us some idea of how much risk we're willing to take on. Now, compared to other funds with the same beta, our alpha over the 10 years is 4.14. So if you just went out and programmed a computer to create a portfolio of 0.63 beta, and it bought a bunch of high cost managed mutual funds and bad performance and all that stuff, we look 4.14% better than just the averages. And why did we do better? Because we sought out low cost broad market index funds. We sought out specific allocated index funds or passively managed ETFs that give us some value back with low cost. And we sought out managed funds that might have had a higher cost, but their return was much better than the index. So we beat in this portfolio, not us. Had you had these same positions over the last 10 years, this portfolio in the past, not going forward, beat others like it by 4% a year. That's amazing. So it doesn't mean you'll do that, but it means that you're in good company, right? Going down a little further. Again, this will tell you we're mostly high yield stocks and bonds, cyclical things that will move up and down somewhat. All of them do, but we don't have a lot in growth. Then we go down and geographically, and you can see these charts, but I want to go down here just so you can see that if you do have bonds in the portfolio, nowadays you have to give up credit ratings. You have 14% in AAA and another 1%. So 15% in A-rated bonds, and you have, let's call that 15. So about 30% in high quality bonds. But if you want a high yield and good performance, you've got lower credit rated bonds in there. And if you have lower credit rated bonds, then you aren't worried so much if they're short-term bonds, but you're going to have to go out a little bit further on the duration. The duration here is 4. Now, remember, if interest rates go up 1%, the bond should drop by the duration. So if interest rates went up 1% or are perceived to go up 1%, which they are, the Fed said it already, our bonds should have dropped by 4%. But I've seen some of them only drop by 1 or 1.5. Or the high yield bonds, because they're so far out of everybody else's yield range, they earn so much, they didn't drop as much. So we didn't lose as much on our managed bond funds. So we could eke out a longer duration. Today, I'd like it below 3 or 2.5, because that means if interest rates go up, the bonds theoretical value should drop by 4%. The average maturity is 6.3. But if you just buy CDs with no yield and you don't do anything, they're going backwards. So we're trying to get some kind of yield. Here's the thing. This portfolio had that one fund with 0.85% expense ratio and some managed funds in there that helped us reduce the downside on the bonds. But the expense ratio still averages out to be 0.27. So that's not bad. Now, if you absolutely disdain managers and you say, Bill, I don't like those at all, then if you go get 4 index funds, you could probably get your average expense ratio down to 0.05. But whenever there's a crash, you better be willing to hold on to, because the total market index or the S&P 500 has been bid up a lot by these technology shares. And so had you had them before, you're down 9.5% as of last week. And now this week, I don't even want to look today. You're down a lot versus if you're in a diversified portfolio, some funds of which had managers. But the opposite is always true. But Bill, they just dropped a lot. Maybe I should buy in. Maybe you should. I don't know where the bottom is. Maybe buy in 10% or 20% and give it a month and buy in a little bit. Please understand yourself and trust yourself. Nobody out there is that smart that they can predict the future. They can't. They can gamble. When they're right, they win. But imagine a mind reader goes into a poker game. Who do you think is going to leave with all the money? And do you seriously think those other poker players would come back to the game if they knew they were playing against a mind reader? So at this point, the market's going to ebb and flow. Manage your portfolio the way that it works for you. Don't worry about what other people are doing, because as soon as we do, we become one of those additional people at the end of the line that paid that bid up price for a stock or a bond. Do what's right for you. If you feel this is a buying opportunity, good for you. It might well be. In December of 2018, the market dropped, and it was a buying opportunity because the Federal Reserve capitulated and didn't raise interest rates so much. But now we're looking at a lot of variables. Do you get out of the stock market right now out of fear that it'll fall? No, you have a portfolio that has short-term, very little or any volatility, has intermediate term funds that have half the volatility or less. And then it's only that third bucket, and that third bucket can be as big or as small as you want, that represents the stock market. Nobody knows. Well, the people selling annuities, gold, and all this stuff try to pretend to scare you into buying their products, which have huge markups and I don't believe are very good for you, but nobody knows where the market's going to go. As soon as we say it's going to go up, it goes down. As soon as we say it goes down, it goes up. I've seen bond funds go up in value when interest rates were raised. Why? Because that indicated the economy is doing so well, we had to raise interest rates, and the junk bond holders had a sigh of relief. I don't know, but let's do what's right for you. So please take a look at the book, take a look through it and see what you can glean for it for yourself. Look at the checklist, see what works for you and follow the process. But if you have somebody else do it, he or she should know everything about the elements of the funds and the portfolios. And of course, they should be aware of the estate planning and the financial planning. So there you go. Our third class, I think it is. My name is Hunter William Bailey. If you have any questions, you can email me. If you do your own investing, I'm always happy to give people an opinion or look at the portfolio you're planning and say, oops, you missed something, or yeah, that's great. I'm going to steal that concept. If you have another advisor, share the book with him or her. I hope that they can learn the process. And if that advisor wants to call and ask me questions so I can repair your relationship, that's fine, whatever. Build it and they will come. So I hope you had a good time. If it's very technical, just hang in there and pick up the tidbits of what we need people not to do so you can protect yourself. And from there, I hope you'll get as much information as possible. I forgot to look at the next pages. Sorry, guys. I'll have Marcia email that out if she hasn't already. And we'll talk to you next week. Take care, and I'll try to figure out how to turn this thing off.